Let's talk oil, energy, and geopolitics because there are really two very different scenarios happening in the world right now. First, global risk is rising. Don't believe us? Let's lay it out. You got Israel and Gaza still raging, if not heating up. You got Ukraine punching Putin back, good, but they're striking oil targets inside Russia, what the U.S. asked them not to do. China continues unprecedented military buildup and saber rattling around Taiwan. In fact, you might have seen the video. The other day, one of its naval ships intentionally ramming a Filipino Coast Guard ship. And rich with oil, Iran, now close to enriching enough uranium to theoretically complete a nuclear weapon. Oh, and in Turkey, some off-duty U.S. servicemen were violently assaulted by a gang on the streets in the middle of the day. In other words, the world is heating up, but yet oil is cooling off. Right now, oil is down 1.5%. It's $69.34. Now negative for the year. And if you're wondering, oil's fall really is for a variety of reasons that include a disappointing recovery in China's economy, record U.S. production, overproduction from OPEC, at least for now, the member Iraq, by the way, we're looking at you, and a big bearish position from oil traders, betting that oil prices will fall even more. And that is not even the entire story, because now we have some new headlines around OPEC suggesting the group could pause on its plan to add more barrels into the market. So let's dig more into oil and energy with our friend Dan Pickering, founder and CIO of Pickering Energy Partners. We had this all laid out yesterday. You wake up to these headlines on OPEC. Respectfully to my colleagues in the media, I'm not so sure OPEC's going to do anything, particularly before the in-person December 1st meeting, which we will be at. How do you read the state of the oil market right now, Dan?
Yeah, Brian, nice to see you. And the oil market's telling us we've got too much supply, and it's much more worried about the near-term risks to demand than it is about the potential risks to supply. You laid out very well the geopolitical tensions. Those things might result in a lack of supply. I think the market's telling us with this move below 70 that it's much more worried about the demand side and the risks of OPEC bringing back supply than it is all these geopolitical tensions. So I think the market's going to be fine, but it tests us every 3-6 months, and we're having a test right now.
You know, it's interesting you say that, Dan, because we were talking about leading and lagging indicators with the Beige Book. And in a way, oil has almost been a leading indicator this year. Even as we were getting excited all summer long, the stock market's up. We're talking about kind of consumer hanging in there. But oil demand has not been. And like Brian said, yes, China is a piece of that story. Do we know what U.S. demand has been like? I filled up for $3.13 a gallon this morning in New Jersey, and I thought if that cracks $2, imagine the psychological benefit that's going to have for consumers if this economy keeps chugging along.
Yeah. U.S. demand's been mediocre. China demand's been mediocre. Remember that China was 800,000 barrels a day per year for a decade. They're half that right now. The U.S. flattish from 2019. So prices go lower, demand will go up in response to that. But, I think the psychological impact of oil in the 60s is likely to keep OPEC off the market. I don't think you're going to get your $2 and change fill up, Kelly, unfortunately.
Come on. I'm counting on it. We're turning into what you guys know more than me, the winter blend, right? The prices come down. Let me ask you this, Dan. So Amrita Sen had said a while ago that, and we know from the ISM readings, we were reminded again yesterday, that we're in basically an industrial recession, but the consumer has been chugging along, and their TSA numbers show they're traveling, so they're using jet fuel, they're using car fuel. What is the percentage of U.S. oil demand, I don't mean this to be like a quiz, but that comes from big industry versus the consumer? When you say that demand is weak, is it because we're in a post-pandemic industrial reset as opposed to a problem that is a broader economic one?
Yeah, the split between consumption, Kelly, I was told there would be no math, but here it is. Roughly 50-50 between industrial and consumer.
Wow. And
so they both matter. I think that the consumer is much more price sensitive in the near term. $20 for a fill up goes a long way in other places. And so, my expectation is that demand will be okay, but not great for the next couple of years. If we have an economic problem, oil's going to have a problem as well.
Right.
My expectation is we muddle along and supply and demand for oil muddles along and price stays in this kind of $70 to $80 band for the next couple years, which is going to be fine for the companies. But OPEC is the big challenge.